Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer, joined by my colleague, Jeff Meggs, and we're super excited that you've joined us today. Sales and use tax can be confusing and overwhelming, but it doesn't have to be. Whether you work in an industry or a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, in industry, school, or a practicing CPA, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. Hey, I'm Brian Greer, talking about sales tax, frequently asked questions, and what we try to do here is really think back in terms of the conversations we have with clients, with prospects, with businesses in general, and just what do we always hear? What are some of those common questions that we get? We try to categorize those into these 6 different topic areas that you see here. I suspect we probably have somewhere in the range, I probably should have counted it, maybe 10 or 12 different questions that hit on all of these topics here for you today. So my colleague here today, Jeff Meggs, and we're going to jump right into it here and start kind of basic, but tell us, what is the difference between sales tax and use tax?
Thanks, Brian. So commonly when you talk about sales tax, typically the phraseology is sales and use tax. Everybody just says sales and use tax. They are 2 different tax types. And the way to think about the sales tax is it's an intrastate transaction that drives sales tax. And due to the Commerce Clause, the federal government sort of limiting states' abilities to tax across state lines, the states came up with a alternative, a complementary use tax that could be applied when a transaction does happen and cross the state borders and they're not able to tax the vendor. They are able to hold the consumer liable for a use tax. Typically, we would expect the sales tax and the use tax rates to be the same. And ultimately, for sales and use tax, for both tax types, the intent of the tax is to be imposed on the end user consumer. So generally speaking, we would expect the tax to be paid, whether it be by charging the tax to the consumer by the vendor and then reporting it, or the consumer self-accruing and remitting it to the jurisdiction directly. Most of the time, actually, I would just assume that the rates are the same. It's so rare that they aren't. I will tell you, the state of Missouri at the local level does have some variables where the sales tax rate might exist and the use tax rate might be either lower or not existent. But in any case, the way to think about sales and use tax is no different than you probably thought about it before this call. It is intended to be imposed upon the consumption of tangible personal property and enumerated services.
So Jeff, digging like maybe one layer deeper on this topic, I've heard seller's use tax and consumer's use tax. So what's the difference between a seller's use tax and a consumer's use tax?
Yeah, so the use tax is one tax type. And when we talk about it being retailer's use tax or consumer's use tax, all we're really differentiating is who is actually going to report and pay the tax to the jurisdiction. In a transaction that's subject to use tax, meaning an interstate transaction, either the seller or the purchaser can be held liable for that tax. When we're talking about sales tax, in some states, and this is kind of going away, but in some states you actually have to register differently for retailer's use tax as compared to consumer's use tax. You actually have to have 2 different registrations depending on which one of those categories you fall into.
Sales tax.
Just sales tax.
Focus on sales tax.
Yeah, a lot of times when we're delivering taxability reviews or any other type of discussions we're having, we tend to just call it sales tax for simplicity purposes.
Perfect. All right, so here's the next question. Isn't it the customer's responsibility to pay the use tax if I fail to collect the sales tax from them?
So going back to what we just talked about a little bit, if it is a sales tax transaction, it does depend a little bit on the state, but in some states, like in North Carolina, California, if it is a sales taxable transaction, meaning no exemption certificate has been issued by the consumer, and the vendor is shipping from an inventory located within that same state, that vendor is responsible for charging, collecting, and remitting that sales tax. The consumer in those two states I used as examples doesn't really have an obligation to accrue and remit use tax. They can, and maybe they should out of a desire to be totally compliant, but they're not required to. And I'll tell you a little story that kind of lines this up a little bit for you. I was actually meeting with a former colleague of mine a couple of weeks ago. He's with a very large company here in Atlanta, and they have significant operations in the state of California. And the story he's telling me is they're engaged currently in a California audit. And during that audit period, this company had self-accrued and remitted use tax, a large amount of use tax. We're talking $1 million+ over the course of the audit period. And what they discovered was that the vast majority of that use tax that they had accrued and remitted was related to transactions where they bought tangible personal property from an in-state vendor in California. And they actually brought to the California auditor the argument that they erroneously accrued and remitted that use tax, and that it was the vendor's responsibility to be assessed for that as a sales tax. They won that argument, surprisingly, and California removed that, not only didn't assess them, but also refunded them that amount of use tax that they had accrued. So it's a very interesting dynamic. That's not the way it works in all states. And I don't know that I'm able to articulate why some states work one way and some states work another. But I can tell you in Georgia, for example, if the sales tax has failed to be charged by the vendor and it's an intrastate transaction, it happens within the borders of Georgia, the state can hold the vendor liable, but they can also hold the purchaser liable. And whichever one they get to first gets to pay the tax. The other thing that you'll hear from time to time, or maybe even have experienced it, is double taxation. Double taxation is something that can happen. It's just not something that's intentional. And what I mean is that Georgia example I gave, where a customer buys from a Georgia vendor, fails to be charged sales tax, doesn't accrue use tax, the state gets to that consumer and says, you should have paid use tax on this product, we're assessing you. And meanwhile, a month later, they're at the vendor's location, and they're telling the vendor, you should charge sales tax and we're assessing you. And neither company ends up communicating to one another that tax has been satisfied under audit. And so it does end up getting double taxed under those conditions. That happens every once in a while. It's an unintentional sort of byproduct of the way the audit programs work.
Do you have any perspective on how many states are like that in terms of Georgia versus?
I really don't. And it's only because we just have never had to.
You don't see it all that often.
Yeah, it's not something we address. Although my ears did perk up around this California matter, because to be honest, I had never thought about taking that approach.
All right, let's segue here into a nexus discussion. And a lot of times, if you've participated in our webinars in the past, a lot of times we start with nexus, but let's shift gears here and talk about the difference between economic nexus and a physical presence or physical nexus.
Yeah, so for the vast majority of time that we've had a sales tax, it's been predicated on having nexus and a physical standard, meaning I have either an office in the state, employees in the state, inventory in the state, some level of physical connection to that state that allows me to create a market for my products or services and I'm leveraging the resources of that state. And from really 1967's landmark case in National Bellis Hess, where the Supreme Court ruled in favor of the taxpayer, saying it's got to be more than just minimal existence to create nexus. We kind of used this physical presence standard up until the Wayfair decision in 2018. So when you think about physical presence, some of the ones I just mentioned are fairly standard and obvious. Others aren't so obvious. For example, if you're leveraging the use of a subcontractor, or you're subcontracting out some level of service to a local electrician, let's say, to perform some kind of service for your customer, that is another form of physical presence. You're leveraging that resource and then billing your customer for that service. The state would deem you to have a physical presence through the relationship of that agent. That subcontractor kind of becomes an agent on your behalf. Another thing that can create nexus physically is attending trade shows or going into the state to solicit for sales of tangible personal property or services. So solicitation and the frequency needs to be somewhat material, but there's a pretty low standard that we employ. We employ a 3 days per 12-month standard. Once you exceed 3 days in a 12-month period of solicitation, you should be concerned that the state might assert that you have nexus from a physical standard perspective. So in 2018, though, we see things sort of change in a really, really big way with the advent of economic nexus. And today, 5 years later, all of the states have an economic nexus standard for sales tax purposes. And the way I like to communicate it or advise clients to think about it is, if you're engaged in a business activity that generates $100,000 or more in any given state during a 12-month period, you should at least be asking the question, have I triggered nexus? Triggering nexus doesn't necessarily mean you have a sales tax responsibility. It only means that you are now within the grasp of that jurisdiction to impose their taxing authority on you. You might be operating in a fashion that's not taxable for sales tax purposes in that state. So you can create nexus all day long. You don't have an obligation to register or comply in any way, shape, or form. But if you are selling tangible personal property, and there are a number of services, we'll talk probably a little bit more about that later, that are taxable, you should at least sort of, again, raise your head, take a look. Have I met nexus thresholds in that state or those states? And if the answer to that is yes, then you can start down a path of evaluating taxability. What I will tell you as well is those economic thresholds come in a variety of flavors, and there's kind of two primary factors. One is that $100,000 in gross receipts that I described to you. Another is transaction volumes. There are a number of states that have instituted a nexus threshold based purely on the number of transactions in a 12-month period. And that transaction count is generally 200 transactions in a 12-month period. The other piece of information you might be interested in knowing is not all of the states are $100,000. That's the lowest amount, and it's the standard across most of the states. But California is $500,000, Texas $500,000, Mississippi and Alabama are $250,000. So there are some variances out there. And when we talk about gross receipts relative to this nexus threshold, revenue threshold, that too has some variability. Sometimes it's pure gross receipts, every dollar you charge and collect. Sometimes it's only gross receipts associated with sales of tangible personal property. And sometimes it's only sales to end user consumers, or what we'd refer to as retail sales. So there are some variables to be aware of, but the simplest way to think about it is that $100,000 rule. And if you haven't hit that yet, no need to worry about the variables.
And kind of drilling into that just a little bit, you had referenced the 200 transactions as one of those measures, although, again, kind of keeping the eye on the ball of 100,000 as the revenue. I know we've seen at least one state, South Dakota, repeal that transaction volume. They did have a 200 transaction volume threshold. Now it is only the $100,000 revenue. I'll put you on the spot. Are there other states, or do you expect other states to kind of pull back on that transaction volume and just focus it on revenue?
Evidence would tell us yes, because while South Dakota is one of the most recent, there are a number of states that out of the gates, after the 2018 after the 2018 Supreme Court ruling, and then the enactment of legislation across the states, a lot of them had transaction thresholds that have since been repealed. And so those have kind of trickled downward. None of the states, to my knowledge, have added transaction thresholds since 2018, but a number of them have removed them.
Kind of pulled back a little bit.
Yeah, and I think it's okay to think or assume that that's going to happen prospectively as well.
Okay. Last question or maybe comment in this area. We hear this fairly frequently. How would you react if I tell you, okay, I'm a business, and I say, I've got an employee sitting here in Texas, but I only have $70,000. Well, maybe Texas isn't a great example because I think their threshold is greater than $100,000. But regardless, I've got an employee that's in Texas, and I only have $75,000 in sales. I'm under the economic nexus threshold. I guess I don't have to do anything in Texas, right?
Wrong. The short answer, when we start talking about nexus and the clinical aspects of nexus determination, there is a good bit of gray, but there's a good bit of black and white as well. And generally, I tend to fall on the side of, if you've got an employee there, regardless of their activities, if they're resident there or they're spending a great deal of time there, I would just assume that the state's in a position to assert nexus. And now, whether or not $75,000 of taxable sales exists, or if it does exist, whether or not that's material to the business in terms of whether or not to register and comply is a different question. But clinically, I think you'd have nexus, and if you were selling tangible personal property on a retail basis to end user consumers, you would have a requirement to register and comply.
All right, makes sense. But we'll shift gears here to marketplace facilitators. So Jeff, what is a marketplace facilitator, and what are my responsibilities when working with one?
So generally, a marketplace facilitator, I should add, is really someone that offers a platform where third parties can bring products to sell. And the key with regards to the definition of a marketplace facilitator for sales tax purposes is that not only is that platform made available and that third parties can leverage it, but the platform itself, the facilitator, the marketplace facilitator themselves can actually process payments. So that's the key element. There are a number of big name platforms out there that you might think, well, that's got to be a marketplace facilitator, but they don't accept payments, or they don't process the payments of the transactions, and that's a critical element of it. So one of the things that happened as a result of Wayfair was that the states were able to then expand the legislation to include marketplace facilitators, and so the threshold, the revenue threshold primarily, is what would apply here, has been expanded to include marketplace facilitators, which means if you are characterized as a marketplace facilitator and you have met that revenue threshold, you're obligated then to register, to charge and collect tax on all the transactions that go through that platform. So it's in a way, it's helpful to the small business who doesn't have the wherewithal or the resources to even manage or touch a sales tax compliance function. But they also don't want to keep up with their nexus footprint, and they want to just see their business bloom and blossom. If they're operating through a marketplace facilitator, it's actually a good thing for those people. If you can call taxation a good thing. Now, we all know the common names, Amazon being the biggest of those, I think that everybody's pretty familiar with. Right.
If I'm selling on one of those marketplaces, and we're going to touch on this a little bit here coming up in just a minute. This is kind of a different question though. We're selling through a marketplace, but I'm also selling on my own website. I've got sales coming in through salespeople. So I've got legitimate taxable sales where I'm collecting the tax, and then I've got this marketplace over here that's collecting and remitting the tax on my behalf. Then do I have to report at least the sales from the marketplace, or I think it probably varies state by state, doesn't it?
Yeah, in some states they have legislated that you would report sales through a marketplace, even though you wouldn't have the responsibility to pay any tax or collect any tax. Statutorily, that is one of the requirements, and I can't tell you how many states that is, but there are a number of states that have established that as a reporting requirement.
All right, and continuing down this marketplace facilitator pathway, kind of on the same path I was on with that previous question, but if you sell on Amazon as well as your own website, how does selling on Amazon, how does that affect Nexus specifically?
Yeah, again, it is a little bit similar to what you just asked in that the states have variability. You know, as I was describing the Nexus thresholds earlier and the variables that were involved in that, this too is another variable, meaning in some states, your gross sales that are attributable to determining Nexus for economic Nexus perspective have to include sales through the marketplace facilitator. In other states, you can exclude those sales that have gone through the marketplace facilitator in terms of the threshold requirement. So it is a state by state, and it's the reason why I go back to that original statement and ask people to think about it as a $100,000 threshold. If you have gross receipts in excess of $100,000 in a given state, look into it. Examine that state's requirements and understand whether or not you're meeting that threshold yet.
All right, perfect. So, Jeff, my company only provides services. What type of sales tax concerns should we or would we have?
Yeah, you know, similar to when I mentioned on the Wayfair, the economic nexus standard, and I said once you hit that $100,000, you ought to at least ask the question, have I reached Nexus? I think it's a good idea when you're really predominantly a services organization and you've triggered Nexus to also ask a general question about the taxability of your services. And the reason is there are a host of services which can be taxable depending on the state. And it is a tricky area, you know, and everybody's interpretation in terms of terminology can be a little different. I used myself earlier in this discussion the term professional services to describe what we do here in Georgia. But professional services is a term that gets overused, and in the sales tax arena, what I mean by that is it gets overused as a reason for exemption. So an example I would give you is in the software industry, there's a lot of times associated with the sale of software, whether that be in a tangible form, downloaded software, or even in a software as a service fashion, there can be services that are separately charged that are associated with that sale or that subscription. In some states, those services may be taxable. In other states, they may not be taxable. And when we talk about software in particular, California being sort of a big hub for technology and software companies, those companies fall into this trap more often than anyone else because they start to trigger Nexus economically outside the state of California, and then they realize that software delivered electronically is taxable in a lot of states, and then they realize that some of the ancillary services associated with that sale are taxable. So what we end up seeing is due diligence being done on an acquisition where the buyer sees all of this and understanding the implications of sales tax outside the state of California, they tend to either reduce the purchase price or escrow an amount that needs to be mitigated or force mitigation. So I think one of the other things I would say is when we do talk about professional services, the key professional services that are generally going to be exempt in most, if the majority of the states, I'll call it, those would be things like engineering services, architecture, accounting services, lawyers, doctors, you know, those kind of medical or legal services. Those 5 categories are what I would say make up what I call professional services. But even in that instance, states like Hawaii, New Mexico, there's still potential taxability in those categories. You know, more states are leaning towards taxing services. particularly as our economy becomes more service oriented. And then technology is just going crazy out there, and states can't keep up with that. But more and more technology aspects of the industries are getting taxed. Communication services is a huge tax revenue stream for all of the states. So communication services are generally taxable everywhere in some form or fashion. It may not be a true sales tax, but it's got some relevance like a sales tax. It's transaction based. And lastly, I'm not going to go into a lot of detail on this one, but usually when we think about the taxability of services, they're associated with sales of something else that's taxable. So we have installation services associated with the sale of furniture. We have delivery services associated with the sale of paper. These kind of services start to get taxable because of their association with the sale of tangible personal property. So it's a mixed bag out there. It's a treacherous place when you start getting into services, and a lot of differentiation from state to state.
I think the fact that more and more states are taxing these services is fascinating from the perspective that politically it's an easy way for states to increase their revenues. So rather than say, as a state, we're going to raise the tax rate from 7% to 7.5%, where everyone would have a major outcry over something like that, the state's able to kind of capture some of these services or other items that maybe historically weren't taxed, increase the tax base, and increase the revenue for the state without it being on the front page of the paper that, we're increasing the tax rate, and that would throw everyone out of whack. So it's fascinating, I think, to see how that plays out. All right, so you mentioned a little bit about, and I may have skipped ahead here, selling software and computer services. Is there anything we should be concerned about with sales and use tax? You touched upon that, but I think we've got a little bit more to.
Yeah, I'll just add a couple of pieces to what I already discussed. Just to clarify, one of the key elements of services that are typically associated with software are configuration services or implementation, installation type services. And there are a number of states where if the software is taxable, that accompanying configuration, even though it's a separate charge on the invoice, is also taxable. Not every state, but there's a good number that do tax that level. The other area that can get a little confusing for some is customization. So we've all been familiar with the term of custom software probably. Custom software has had its own evolution from a taxing perspective. And what I mean by that is when software used to be sold primarily in a tangible format through a disk or CD or something like that, there used to be options whereby the vendor could provide some very limited and inconsequential customization to that software, and by doing so create an exempt or a quote unquote customized software package. To tell you how easy it was, in North Carolina, this is 25 years ago, maybe 30 years ago now, if you just programmed the software that when you opened it, it said, "Good morning, Jeff," you just customized that program, and you took a $1 million ERP system and made it totally exempt from tax just by that one little customized effort. Well, the states have closed that loop. So now, in today's world, it's either got to be customized in a fashion that it's written from scratch. It's not leveraging an existing pre-written package and then customizing it to your liking. So it's either got to be purely customized written from scratch, or to the degree there is customization to a pre-written program that's otherwise taxable, the separate charge for the customization effort can be exempt from tax if it's fair and reasonable. So again, you couldn't go out there and sell $1 million ERP system and then try to add "Good morning, Jeff" to it and say, well, that's valued at $500,000 for that customization. So the states are wise to those scenarios. I won't say the auditors are wise to it, but the state in general is wise to that. So yeah, just again, it's about being aware when you meet those nexus thresholds that I've got services that feel exempt. They've always been exempt everywhere we've operated thus far. If I go into a new state, I should not necessarily assume it's always going to be exempt.
All right, perfect. So we're going to move into a taxability discussion here. And a good piece of what we've talked about up to this point has been around taxability, but in this specific question, we're going to look at a company that is only involved in resale activities. So we only sell products to other companies for resale purposes. Should we worry about multi-state sales tax?
Yeah, and I think, again, we touched a little bit on this in one of the examples or storylines I had earlier. If 100% of your sales are to resellers, statutorily, once you've triggered nexus or created nexus in a state, it's more likely than not that that state's going to want you to be registered for sales and use tax purposes. However, from a practical and sort of business management perspective, as long as you're getting the proper documentation, the resale exemption certificates properly completed, you're usually going to be safe. And I say usually, our experience has been that that's adequate to prevent any sort of assessment or liability. Notwithstanding what I just said, you got to make sure that there's not other parts of your business that could be creating exposure for you along the way. I want to be careful when I characterize the fact that I don't necessarily encourage registration. There are definitely statutory requirements that you would need to be registered in these cases, and there can be some hefty fines available to the state if they wanted to leverage them. So make sure your house is clean from top to bottom if you're going to take the approach, 100% of my stuff's resale. I got all my exemption certificates. I'm just going to not register right now. That isn't a bad decision. But if you've got other issues within the business that aren't being managed well and there's some tax problems, the state would have a club to come in and hit you on the head with if they wanted to.
And there's always the advantage in that scenario of registering and filing just to get a statute of limitations running as well, because you might make that decision that not to register, not to file, because you don't have any tax, there's no risk for exposure, so you think, but there is no statute running in that scenario. So we do see companies, even with zero taxable sales, wanting to register really for that primary purpose. So next question, what sales tax risks does my company have if I acquire another company who may not have been in full compliance?
Yeah, acquisitions, I tend to think of them in two categories. One is an equity acquisition where the federal ID number or the legal entity structure is going to survive the acquisition and continue to be owned and operated by the buyer. In those scenarios, the buyer is inheriting all of the sales and use tax exposure that comes along with that entity. There can be exceptions to that. There's a lot of nuances and scenarios, that when you get into illegal activities that might not transfer just because officers might be held illegally or criminally, I should say, liable for something they might have done previously. And we're seeing a pretty consistent sort of application of due diligence across all acquisitions, all companies, where the buyers are savvy enough today and they recognize the risk of sales tax, particularly in technology industry. They're taking a pretty close look at it. When I say close look, they're not necessarily going to transaction level detail, but they are sampling transactions, looking at revenue sources, revenue categories, and then assessing the nexus footprint of the company as well as their level of compliance. What does their tax calendar look like? The other category outside of an equity acquirer is basically an asset acquisition. So in some ways, and even historically in some states, you could go through an acquisition of assets of a business and not inherit any of their sales tax liability or risk. I would say that you should assume you are inheriting some level of risk, however. And then what a number of states have said is you have to file some paperwork, some sort of form that outlines that a bulk sale of assets has occurred and that the sales and use tax accounts have been evaluated and are clear, to absolve yourself of any subsequent successor liability. So I would say just assume that there is risk, whether it's an equity or an asset buy, a lot more risk at the equity level. I'm seeing more and more, and I had a conversation with somebody a couple of days ago about this, and we did a project in 2022 with a company where both scenarios were asset acquisitions, and the buyers put in the clause of their contract either a reduction in sales price or the seller had to mitigate all the sales and use tax identified in due diligence. So notwithstanding the fact that they could have avoided successor liability, they forced the hand of the seller to mitigate. So the cost of compliance is going to hit you at some point. Do you want it to hit you at the beginning when you can pass that cost on to the consumer or the customer? Or you wait and ultimately you're going to pay out of your own pocket. Not only that, you're going to pay penalties, potentially some interest. We'll talk about that here in a little bit. So it can get expensive. So yes, there's some successor liability risk.
So Jeff, in either pre-acquisition or post-acquisition, if you do have some level of risk or exposure, what are some options to help mitigate that risk?
Yeah, fortunately for us, in the event that you've not been compliant in any way, shape, or form, meaning you haven't been registered, you haven't been receiving inquiries from the states, there's a number of options. One option might be to just register prospectively. So probably not the approach that gets taken more often when there's prior period risk and there is an acquisition. But we've been involved in some due diligence and transactions where we've negotiated sort of plans of procession that don't include prior period mitigation. But in any case, there are scenarios where it just makes more sense to go ahead and register and start to comply prospectively. And we're assuming in those cases you haven't collected any tax in the past, or at least nothing material. And if you did collect, you have to get that tax paid into the state as soon as possible. And then if you did have prior period risk, maybe you accrue for it in the eventuality that you're audited, so you've got some at least financial statement offset to any future expense. The other option is you could simply register effective when Nexus started, which might have been a year, 2 years, 3 years ago, and you could make that your effective date. So you could say, my effective registration date is January 1, 2022, and you would then have an obligation to file all the returns from January 2022 through, at this point, we're now at September of 2023. And in doing so, you'd have to report all your tax. You would be assessed automatically and systematically penalties and interest on all of those filings. So it's an option. It's not a very attractive option. It takes a good bit of effort, and then if you do want to get any relief, you've got to go through an exercise of requesting relief from penalties. You're not going to get any relief from interest. The last and most popular option in these scenarios is to do a voluntary disclosure. We call them VDAs, which stands for Voluntary Disclosure Agreement. And the voluntary disclosure process is available virtually in every state. It does, like I've talked about, I think, throughout this entire discussion today, it does vary. There are states that do different things with their VDA programs. But the consistent messaging I would have on the VDAs is it's a really attractive process, both for the buyer to sort of require the seller to actually take part in, and it gives them sort of a clean slate going forward. But it can also be beneficial to any company who recognizes their risk and their prior period exposure, particularly if they've collected some tax and they have to get that tax remitted and it's material. So anyway, the VDA programs are very attractive in that regard.
All right, so perfect segue into the last question. We actually made it to the end here with a few minutes to spare. But what are some of the specific benefits of executing a VDA?
There's really two benefits to VDAs. One is abatement of penalties. Generally speaking, if you've not collected tax and you're coming forward in a voluntary capacity, the state is going to automatically approve penalty waiver under that voluntary disclosure agreement. So that's a scenario where you've had nexus maybe for 5 or 6 years, and you've had a responsibility to charge and collect tax, but you never have. And now you're either going through due diligence or you just discover as part of the company's process or audit, you've got something to clean up. Those are great scenarios for that. If you have collected tax, I will tell you there's a certain number of states that just frown upon that, and they will have some minimum fee or what I would call a penalty associated with the collected tax under those conditions. So they may impose maybe up to 10% tax on, 10% penalty on taxes that have already been collected. But if you haven't collected the tax, you're going to get that fairly automatic penalty abatement. But the real benefit of the voluntary disclosure program, in my opinion, is not even the penalty abatement, but what we call the limited look back. So in that scenario I described, you got 5 or 6 years worth of accumulated liability and risk because you should have been registered 6 years ago. You should have been charging and collecting tax, but you didn't. And what the state's going to agree to in the VDA is to limit their look back. They're going to say, well, we hear you. We appreciate you coming forward. We recognize you didn't charge and collect. So what we're going to say is you only have to go back 36, maybe 48 months to disclose your liability. You get to keep and just eliminate any liability beyond that 36 or 48 month period. And that to me is the true value of the VDA. It's eliminating that inherent tax that should otherwise be assessed. And if you didn't go through the VDA and you're contacted by the state in the future without having started the VDA process, you're stuck. You don't have the VDA option at that point, and now they're going to go back 6 years. And not only are they going back 6 years, but they're going to put penalty and interest on top of that.
And I know we've seen some pretty unique scenarios in the past where, one kind of jumps out at me where the client had very little taxable sales in the previous 3 years. But when we looked at years 4, 5, and 6, they had a substantial business in the state and a substantial liability and risk there. So even though they didn't have a lot of ongoing sales tax responsibility, the VDA made sense to really carve out those older periods, get them compliant for very little, out-of-pocket cash to satisfy the tax due for that 3-year period. So it can really be advantageous in the right scenario. This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.